Everyone, as you know, I think I know at least half of the people on here, but for those of you who might not know me, my name is Jason Van Dyne. And today we have with us Mark Peterson. So for those of you who have joined us before for these or watched the replays, Mark works at the largest asset manager in the world, who we have partnered with in some of our asset management. So Mark is a director on the market and portfolio team. He's been doing this for like 25 years. Quite frankly, I think he did an amazing job the last two times. So I expect nothing different this time. As always, I'll probably, jump in and make a few comments here and there. And a little bit of background on Mark was that prior to joining BlackRock, he was a director as well as head of product strategy, which is a big deal. So head of product strategy and economics for Deutsche Bank, which in America, we don't know that much about Deutsche Bank, but they're a gigantic global bank based in Germany. So he's also spent time on the floor. He was actually on the Board of Trade and the Chicago Mercantile Exchange. And Mark graduated from Arizona State. So with that, I will turn it, Mark, over to you and to get us going here.
Great. Thanks, Jason. Evening, everybody. Thanks for having me on your call today. Talk a little bit about the markets here in 2025. Certainly no shortage of content, a lot of things going on, especially this week, given everything with confirmations of cabinet members. We've got an inflation number coming out tomorrow. Lots of things that we can talk about, and we'll do it through what we call our Student of the Market piece. This is our market outlook for 2025, but something we do send out monthly to advisors across the country. If you actually Google it, you can Google BlackRock Student of the Markets, it'll pop up, and you can see this month's edition versus some previous months as well. And what we try to do is just highlight some of the things that we're seeing in the markets, in the economy for advisors. So hopefully things that are understandable. You'll see right away I'm a chart and graph person, so didn't leave many in the bag tonight. So bear with me. We'll try to bring them to life as much as we can and give you a flavor for what we think is going to unfold here in 2025. Certainly not meant to be a crystal ball, but just give you a feel for where we think we're at in the overall cycle, where markets and economies are, and generally still in a pretty good place. So with that long preamble, let's get after some of these charts here. First off, just review last year ended up being a really good year for U.S. stocks. We were up 25%, second year in a row in which stocks were up 25% or more. It was up 26% in 2023. So pretty rare to be up 25% 2 years in a row. It's only happened now 5 times historically, going back to 1926. So almost 100 years of data. Only the 5th time it happened. Last time it happened was 97 and 98. And 99 was actually a good year. It was up over 20%. So you had 3 years in a row back then when stocks were up over 20%. But you can see across the board, some of the other categories or asset classes didn't do quite as well. Bonds were up about 1.25%, gave some back at the end of the year. But overall, you can see on the very bottom, if you just look at the by the magnifying glass there, if you look at the various Morningstar categories, which is just categories for mutual funds and exchange traded funds, and there's 114 categories, believe it or not, all but 6 of those produced a positive return in 2024. So that's certainly what we would hope for, where you see most categories delivering a positive result, led by stocks up over 25%. And one of the things that's behind the success on the stock side is the surprising strength of the economy. Here's the U.S. economy. So just the overall growth rate of the economy. It's not stellar growth, but it's reasonably good growth where you're seeing it between 1.5%, 3%. Probably you'll see some numbers revised down a little bit here going forward, but still well away from that recession territory. And I think that's really helped U.S. stocks, right? We want to see the economy continue to chug along. There's a lot of money still in the system from the COVID injections from a money standpoint that we did as an economy. So a lot of money sloshing around. I think you see that in a lot of asset classes, stocks near record highs, Bitcoin near record highs, housing market near record highs. record amount of money in money market accounts or those dollars on the sidelines. So there's a lot of money out there, and that's certainly helping the economy in the near term here. And you see the job picture still looks pretty good. We are actually at 4.1%. They on Friday they actually had the updated unemployment number was 4.1%. So that's well away from what you would expect in an economy that's going into a recession. We just don't think that's the case. We think that'll continue in 2025. It's certainly not a robust economy where there's some areas and pockets of weakness. Manufacturing still is pretty soft. The job makeup isn't maybe is exactly the way you'd like it. There's a lot of government and healthcare and recreational related jobs that are dominating the job picture. So it's a little bit of a mixed bag, but still on very solid footing from an overall economic standpoint.
And I think what's important too there is, that the US growth looks okay. Like people think 3%, and they're like, I don't know, 3% is spectacular. Most of the other developed nations in the world are at 1, right? Like, so I know 3 might not sound big, but 3 on top of the biggest economy in the world, compounding compared to 1 in most other countries leads in a very short amount of time to a gigantic GDP difference.
Yeah, one if they're lucky too, Jason, right? You have areas like Germany that are basically at 0.
Yeah.
So really struggling post-COVID to get any kind of economic momentum going. I think that's a great point. Inflation story. Jason knows I'm a bit of an inflation geek, so always trying to work it in here. Inflation was 9.1% back in June of 2022. And it's down to 2.7%. We'll get a new number tomorrow for December. So it is lagging a little bit here, but 2 points, it'll be right around 2.8 or 2.7%. And you can see the breakdown of the various categories. And I only did this because there's a lot of that yellow bar there, and they call it core services. But the biggest component there is actually shelter, or what you rent your house for, or apartment or condominium for. So it's actually mostly rents in that yellow piece. So that's really been the biggest persistent piece within inflation, is what they call that shelter piece. And we're seeing that number come down. It's just coming down a lot slower than what we'd hoped. So that's something to keep an eye on. I think I looked at it without that shelter component, and inflation without shelter, and shelter is the biggest component of inflation. It's 36% of the overall calculation. But if you took that out, inflation would be well below 2%. It'd be 1.6% today. So I think that's an interesting story. But that's one reason why inflation's a little bit elevated, but still well lower than what we saw back in 2022.
Yeah, and I think from my perspective, this is the whole story of the economy, right? The whole story of the economy has been interest rates are going to come down. As interest rates come down, bonds are going to go up, and it's going to support the stock market. And that predominantly happened. You can see those starting kind of at maybe the fourth quarter of 23 all the way through 24. Inflation has not come down all that much more. And if you couple that with Trump being elected, right, and some of his policies, I think generally speaking, he's a business person, right? He wants growth. He loves growth. The upside of that is the economy might grow. The downside of that is that growth might come with some inflation. And that is why you've noticed long-term interest rates. So if you're looking to buy a house or have credit card debt or student loan debt, you'll notice, or even buy a car, that interest rates have really gone up in the last 3 months. And that is because the Federal Reserve thought that they were going to drop rates maybe 6 times next year. And now they're estimating probably closer to 2 or 0. So, we'll see if rates stay elevated. That it's now that they're higher, it'll be good for bonds moving forward. But interest rates at almost 5% again for the 10-year Treasury, could be a significant headwind for stocks, for 2025.
Yeah, I think that really fits our next slide here. You mentioned the Federal Reserve lowering interest rates. They did it 3 times last year, brought interest rates down by about 1%, at least shorter term interest rates from about 5.5% to 4.5%. And that combination, along with a good economy, look at what that means for stocks and bonds on the left side of this chart. This is a Federal Reserve rate cut, which they started in September of last year. They cut again in November and then December. Maybe they cut once, as Jason said. The market's kind of pricing in one so far this year, maybe two. There's some folks within BlackRock think we might get more than one. But look at that combination is really good for portfolios, both on the stock and the bond side. When you get a Federal Reserve rate cut and no recession within the next 12 months, on average, historically, stocks do about 18%, bonds do about 9%. That's the really good story for portfolios. And you start to break out that story a little bit if it breaks down. Look what happens. Look at the difference with stocks here. If you get a Federal Reserve rate cut, but a recession coincides, it's a completely different ballgame on the stock side. Bonds are good under either scenario because you're getting lower interest rates, but the stock story is completely different based on the economy's ability to continue to avoid recession. Because when you get into that recession, of course, that impacts company earnings, company profits, company dividends, and that's what we want to avoid. So the story, we think, is still leaning into stocks. We still like stocks into 2025. Might not seem super intuitive, granted that given that we've had two really good back-to-back years, but we still like that space. We're still adding to income where we can find it in the bond space. We think it could be a good story, especially for the back half of 2025, and just diversifying as much as you can where possible, where it makes sense, adding to some categories that might not be traditional for a lot of folks. On the stock side, I think this is one of my favorite slides. Jason's probably seen this one from us before. Just looking at the range of returns for U.S. stocks since 1926. So just putting calendar years in various groupings based on the overall level of return. And I think it tells a great story of how you make money in stocks, right? You get some of those years, you're going to have a bear market year. We've had 6 of those since 1926. You're going to lose money 20 times. Stocks average around 10% per year if you averaged out all these calendar years. But look at the fact that you only finish around that average between 8 and 12%. That's only happened 6 times. So stocks might average 10%, but they rarely finish around that average. And of course, last year was a great example of that, up over 25%. You see that in the bottom right-hand corner. But this is one way to think about stocks. Just hang around for those great years. You need to stay invested and be invested in the U.S. stock market for that right-hand side column. 38 years where you've done 20% or more on U.S. stocks, I think is pretty amazing. 15 years between 12 and 20%. That's a pretty good odds. And this is what we want to work in our favor. Let's just hang around and make sure we're in the market for some of those far right-hand side green column calendar years. And, we talked about the last 2 years being really good years, but we did have a bear market back in 2022. Right, that was all about higher inflation and the Federal Reserve having to increase short-term interest rates to really corral inflation, which has worked out. But the bull market, right? So just the good stretch for stocks is still pretty young by historic standards, and certainly we lean a lot on history and student of the market. And you can see we're only halfway into what's normally a 55-month bear market, or excuse me, bull market cycle. You can see the average return is only less than half. Normally, you're up about 200% in a bull market, where we've only been up 74% since the most recent bear market. So you can see the median bear market lasts a little bit more than a year. It's down about 30%. But I think this bodes well for 2025. As long as we keep that backdrop of lower interest rates from the Federal Reserve and an economy that avoids recession, I think this bull market can continue. On the bond side, that wasn't as good of a year. And look at how the picture for bonds is very different than stocks. And this is probably not surprising to anybody who's been a bond investor for a while, is you get most of the years finished right in the middle, right? Anywhere between 0 and 10%. You can see, what is that, 59 plus 17. If my Arizona State math is right there, what's that, about 76 years roughly, that finish right in the middle, right between 0 and 10% for bonds. That's why they're a part of all portfolios. they're that stability, that predictability that you hope for. Certainly last year we gave some back at the end of the year. As Jason mentioned, interest rates really climbed the last couple months as we were not going to get as many Federal Reserve rate cuts as the market was hoping. So they took that out. But I think this is a good picture for how bonds are so very different than stocks, just from a return expectation standpoint. And we are optimistic for bonds in 2025. And one of the reasons why is that the inflation adjusted income for bonds is as good as high as it's been since 10 years, 2020, 2015, right around 2% right now. If you just took the 10-year US Treasury bond interest rate is around 4.8% today. I mentioned inflation is at 2.7, maybe 2.8% tomorrow. That's 2% of real income above the level of inflation. That's really attractive for bond and fixed income investors. Look what happens to bond returns whenever you invest, when you've got just a positive real yield income above inflation story that we have today. You average 8% in bonds and fixed income over the next 12 months. Versus when you have income that's below inflation, certainly bonds are much less attractive and returns are around zero. So I think this could be a nice story for bonds in 2025. I think one of the challenges the bond market's having is the U.S. debt has gotten so high, and we're refinancing so much debt in 2025. I think I've seen the number anywhere between 7 and 9 trillion that we need to refinance. So there's a lot of U.S. debt coming into the market. I think the market's just struggling digesting all of that refinancing activity. But again, I think at the end of the day, the fact that you're getting real income above inflation for bonds, the best that we've seen in almost 10 years, I think that story will eventually play out here in 2025.
Yeah, and LPL Research agrees with that 100%. They actually have a scenario where they think bonds could perform equally with stocks this year. If stock valuations are so high, right, as the market has gone up, that if interest rates stay high and valuations come down a little bit, based on this 8.1% number that bonds could do, stocks might be somewhere in that neighborhood, right? So is it better to take all the risk in the stock market, or should you be reallocating a little bit more to bonds? And I'll tell you, we as a firm have been reallocating a little bit more to bonds as we've rebalanced for the last 6 months.
Yeah, no, absolutely. I think that makes a ton of sense. Oftentimes, especially when you've had 2 good years in a row for stocks, right? You're probably due for a pullback or at least a slowdown of that ferocious pace. And certainly bonds have had a challenging period the last couple of years. So it certainly makes sense that you start to reset back to more historical averages for both asset classes. And here's the interest rate story, really the last couple of years, where longer term interest rates, once we reset them to a more normalized level, remember these interest rates were actually below 1% during the pandemic. Once we reset them post pandemic in 2022 above 4%, they kind of bounce between 3 and 5% here pretty consistently. And one thing that's worked is just looking at various fixed income categories that oftentimes utilize a more active approach. So not just investing in an index, but an active approach, meaning a portfolio manager can make some adjustments, take advantage of some opportunities that happen as these interest rates bounce around the range. I think you'll hear from the press all the time that index funds are the greatest thing ever. At BlackRock, we have equal amounts of both. This is a great example where active funds have actually outpaced the index in the bond and fixed income world pretty consistently. But the press will never tell you that story because they never like to tell you that other half of the piece. But this is a great example of where active managers have added a lot of value here recently. Look at the returns really since the start of 2022. Some of these active categories like multi-sector bond returning over 8%, well outpacing cash and that core bond index, I think is a story that we're going to lean into here in 2025 as well. And last thing I was going to touch on is just look at some of the alternative categories. And what we mean by alternatives are just things that are not traditional stocks or bonds. So some of these categories that utilize both stocks and bonds or alternative asset classes in different ways. They're actually really good in these environments because they tend to give you a return above cash. So if cash has certainly come down with the Federal Reserve lowering interest rates, but still going to pay somewhere right around 4.5%, which is still pretty good relative to recent historic standards. Right, we were at zero for many years on cash, so that's certainly refreshing. But these strategies actually give you a return above cash. So these are some strategies where appropriate for certain investors might make sense. Certainly, Jason and team can help you out there. But I thought we'd just point that out because I think it's just one of these things that folks haven't had a lot of exposure here, but might make sense for certain folks.
Yeah, and I think from our perspective, a Quest Wealth uses a lot of that last one, right? So kind of like the market neutral, where if the market goes up, you make some money. If the market goes down, you either don't lose or make a little bit of money. You can see the standard deviation in the little black bars underneath it. It's just a way to say risk, right? How volatile something is. So when interest rates are high, a lot of the for example, structured notes that we use could end up falling into that category where you have very low risk. If you look at like US stocks, I mean, they're 4 times the risk of the equity market neutral. And when rates are high, they don't even perform as well. So even though they are incredibly time intensive for us and our team to effectively utilize in portfolios, but as we've insourced more and more of our management over time, we have used a lot of those, and it's really done great.
Yeah, it makes a ton of sense. We're seeing a lot of interest in that, where folks want to get some exposure to the market, right? But they want some ability to protect to the downside, or at least diversify the overall portfolio. So for us, we think that continues here in 2025. So that's probably enough charts and graphs for you for a Tuesday evening. Hopefully that was helpful. Think about where we started, right? 2 good years in a row, back-to-back calendar years, above 25% is pretty amazing. Only the 5th time in history in the last 100 years that's happened. We think that'll continue. And mostly because we're getting that combination of the Federal Reserve still looking to lower short-term interest rates. Maybe it's only once or twice this year, but still the right direction. And as long as we don't have a recession that coincides, that's a really good combination, especially for U.S. stocks. We mentioned the strength of the economy. Watch that inflation story. I agree with Jason. I think that'll be the key piece. I think there's some folks concerned that inflation might tick back up. We're more in the camp that inflation will continue to go lower, especially because that rental piece is still coming down. And that's just such a big piece of that inflation calculation. It's just been slower to come down than we would have thought. And then finally, that diversification piece, the fact that bonds, that real income above inflation on bonds is the best we've seen in 10 years. I think is a really attractive story, and just building in some of that diversification, whether it's bond or some of those alternative categories, we think will help protect you to the downside as well if stocks do eventually have a little bit of a pullback here. But for us, still pretty optimistic here in 2025. Again, remember that lower interest rates from the Fed, no recession. Boy, that's tough to beat. So, Jason, I'll stop there, see if there's any other thoughts, comments, questions out there.
Yeah, so I'd love to open it up to the group. And let me see if I can change my view here, where if anyone, I think you're able to raise your hand, right, by clicking on that the little hand icon. So if anyone has any questions, you can also just unmute yourself and feel free to hop in and ask any questions while you still, Mark is a very limited resource. So if you don't get them now, you got to wait 3 months, right? So anyone that has any questions, Sharon, did you just unmute yourself?
Yeah. So what do you foresee as risks like associated with like high credit card debt and the fact that personal debt seems to be rising? Thanks.
Yeah. Yeah, it's a great point, Sharon. You're seeing some weakness in some, forward-looking economic indicators. So things that kind of start to raise the flag that maybe the economy is running short. You're seeing it, credit card delinquencies going up, car loan delinquencies have gone up. So you are seeing some of those, but it's still pretty early in that stage. And think about what they call the wealth effect too. I think we all feel this, where if you are invested in the markets, if you own a home or real estate, there's a lot of increase in value in those over the last couple of years. That allows consumers to continue to spend. If that starts to change, right? If we start to see maybe you get a pullback in portfolios, maybe the housing market slows down a bit, right? We've seen that a little bit here lately. Maybe that wealth effect starts to taper off, but I think that's offsetting some of those other what would normally be red flags. I agree with you, Sharon. You've got just the ability for the consumer to continue to spend can't last forever, but we're still probably early innings there. We still got a little ways to go before we become really concerned. But I think it's appropriate to keep an eye on it. There's no question because consumer spending has been tremendous. It's just, I think, extra boosted by the fact that stocks were up 25% and housing market is really at record highs for most regions. That makes everybody feel a little bit more wealthy so they can spend a little bit more.
Yeah, and also debt has not grown, I don't think, as fast as a lot of people think. So for example, your total household debt, so mortgages, right, we're 10 trillion, but that's all the way back in 08. I know as I'm getting older, it seems like 08 was not that long ago, but it's a while ago now, right? I mean, it's almost 20 years ago. So in 08, housing debt was 10 trillion, and today it's not even quite 13. So and if you look at where valuations have gone, housing debt as a percentage, meaning mortgage debt as a percentage of the value of U.S. real estate I would suspect, has even gone down over that amount of time. The non-housing debt, again, I'll go back to like 08, was less than 3 trillion. Today, it's not even 5. So, I think if you look at like what's happened with incomes in the last 15 to 20 years and what's happened to, GDP in the last 15 to 20 years, that amount of household debt as a percentage of income, right? It's like having $100,000 credit card debt. That could be a big deal, right? To some families, $100,000 is a big deal. To other families, they just pay that off each month, right? So as the economy and as incomes and as the GDP has grown and as housing values have grown, so has debt. But as a percentage of those things, they haven't really grown all that much. So the biggest risk is probably higher interest rates, right? The interest that people have to pay on them. If people get overwhelmed because interest rates stay high and they can't make their payments, then you have a problem, right? You start to have bankruptcies, things like that, delinquencies, and then the stock market could suffer. But the debt, other than maybe like just payments because of interest rates, the actual debt is not as a percentage really any higher than it's been in the last 15 years or so.
Yeah, maybe we'll do that next month. We'll do a slide on that next month. Look at the health of the consumer because it actually is, as Jason said, in a pretty good place here, especially relative to what we saw. And I think partially part of that too is we had a recession, a little bit over 2 years ago, right? It wasn't that long ago that we had a recession. Granted, it was, I guess it was a lot more than 2 years ago, but back to the pandemic, right? It was 4+ years ago. That's still pretty young in an economic cycle. So I think generally we just don't see the excesses built up like we did in prior other cycles where the consumer was not nearly as healthy as they are today.
Yeah, and even since 22, you think, okay, well, maybe there was a recession, so we've added a ton. I mean, it doesn't. The debt has only increased by about 10% in the last 2.5 years, but the stock market and our houses are up way more than that, as is income. Is up about the same. So again, as a percentage of the whole. You have to watch I think Mark's right, the health of the consumer, but the total numbers seem big. But that's why I talked earlier about the 3%. Like the US economy compounding at 3% versus other countries at 0.5 or 1 or 0 is a gigantic difference because we're so big. So as a result, the economy can handle more of that debt. All right. So Sharon, I hope that answered your question. Anyone else out there, you can either feel free to raise your hand or just unmute and go ahead and ask. All right. Well, Sharon, thank you so much for the question. They're always fun and we love them. And as always, what we will do is we will be emailing out a replay so you guys can have this. We'll also put it on our website and the YouTube channel. So that'll usually takes about a week or so to get it through compliance and get it up there. So if any of you have questions that you just didn't want to ask publicly, reach out to your advisor, either with a phone call or an email. They'd be happy to respond and get you some answers to whatever your questions are. And with that, I know we've gone a little over half an hour, so that's a pretty good time usually. Mark, anything else to add?
Nope. I appreciate everybody hopping on here. And if you have any questions, shoot those through Jason. We'll get those answered. Oftentimes those questions are some of the best ideas for slides for next month. So
Yeah, that's right. For next
I'll
time.
selfishly steal your ideas and take credit for them. So.
All right, great. Well, thanks a lot, Mark. Again, you always do a wonderful job. I appreciate it. And thank you everyone for joining us. And we will all talk to you soon. Have a good one.